You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Jeff Snider, a global head of research at Alhambra Investments. Jeff, it's great to have you. Welcome back to Market Champions. It's the second time you're here, so it's amazing to talk to you once again.
Thank you for having me back. It's always a pleasure to come back on.
Thank you. So first off, I wanted to talk about what everyone's talking about right now, and that is what the hell is going on with those treasury yields? So is the reflation or, the recovery or the inflation trade, is that finally correct? Are the bond markets finally sort of pricing in this inflation? Or, do you still hold your view that, we're not seeing any recovery or any reflation?
Well, let's be specific. When I say reflation, I know people have different definitions of the word. When I say reflation, what I mean is that it's a temporary period where things are not as bad as they used to be, which is not the same as an inflationary or recovery trend, which is what we've been looking for the last 13 years. So a reflationary trend is basically in the treasury market volatility. So you see treasury yields will rise because the market itself says, things were bad, not just before now. They don't look as bad now, but that's not the same thing as saying, oh, there's inflation coming. We're going into something different, a meaningfully different, categorically different situation. So there's a difference there. And we've had these reflationary trends periodically every couple of years, ever since 2008. And they always look the same way. I know right now people are saying, well, this is a massive treasury sell-off. It's enormous. This is a different. No, this happens each and every time. In fact, the current sell-off is much, much smaller to this point than other reflationary sell-offs have been in 2017, 2016, 2017, and 2013, and certainly 2010 and 2011.
Got it. So, it's sort of just a false rally in a sense. So it's sort of a false move downwards in treasury prices or a false move upwards in treasury yields, in your opinion.
Well, yeah, I don't, false, I think is too strong of a word. It's, we're talking about probability spectrums, right? That's what the market's looking at. The market is saying the probability of better days ahead has just gone up a little bit. Not a huge amount, but a little bit. It's, things don't look as bad as they did in 2020, which is not a very high standard, right? I mean, that's kind of, we should be looking better than 2020, right? And so the market said, hey, it's not as bad as it was last year. So the probability is tilting a little bit toward more of the more optimistic scenarios. That doesn't mean they've tilted a lot toward the optimistic scenarios into inflationary or runaway inflation territory. It just simply means, as I said, that we're in this reflationary period where things don't look as bad as they did.
And what do you think of the treasury break-evens, which are, somewhat over 2% right now? So do you think, over the next 5 years, we will finally see over 2% inflation, or what's your take on it?
I never try to take the TIPS break-evens literally. In other words, if you see a TIPS break-even at the 5-year, which is up to about 250 something, which is the highest in, since 2008, it doesn't necessarily mean that the market is expecting that level of inflation over the average inflation over the life of the TIPS. What it's simply saying is that investors, fixed income managers, banks, whatever in the financial system are hedging against what they're seeing in the short run. And one way to hedge against, for example, higher commodity prices is to buy TIPS, right? Because you're going to get paid by the CPI. But if we're expecting the CPI to be a certain level and the CPI is driven by, say, oil prices, and you can understand why the TIPS curve is sort of inverted the way it has over the last 2 months or so. What I mean by that is the 5-year TIPS break even, which is the inflation expectation closer to the short run, is being driven by especially oil prices that are going up on a supply squeeze. Whereas longer run inflation expectations haven't moved nearly enough. When you get out into the longest run inflation expectations, the 5-year forward rate, it has barely budged at all. And so what the treasury market is saying is look, commodity prices are up. That's going to push up the CPI in the short run, but we don't expect that to have any more than a short run impact. And the reason is because if commodity prices are up more on supply issues than a sustained increase in demand for sure, then that would not contribute to an inflationary environment outside of the short term.
So, if you look at the Thomson Reuters commodity or CRB index, which is sort of the most commonly or one of the most commonly used commodity index trackers, you can see that from the bottom, which was in April to right now, it's up about 90%. And you're saying that, that's mainly just the fact that, COVID has disrupted these supply chains, and, it's the supply side. It's not that, the money printing or the quote unquote money printing is leading to an increase.
Right. If we saw the money printing aspect of it, if there was a money printing component to inflation, we'd see it in the longer run expectations before the shorter run, because that's where the inflation is. Inflation isn't a temporary burst in consumer prices. It's a sustained year after year trend in consumer price acceleration. So the longer run inflation expectations, you would expect them to adjust much more quickly on the money printing scenario than what we're seeing now. In fact, we're seeing the exact opposite. And there's any number of it. And it's not just oil. I mean, oil production has been curtailed significantly and held at a low level for now an entire year. And the domestic production's off something like 17, 18%. That's an enormous reduction in supply on top of what OPEC has cut back and promised to continue to cut back. But you can go to any number of commodities and you see the same thing. Copper is another example. Copper production has lagged the recovery or the rebound in economic activity for various reasons. Some of it has to do with specific locations where a lot of copper mines are. Some of it has to do with the Chinese, who last year were panicking over the disruption of supply and panic bought a ton of inventory that's just sitting in off the books in certain municipalities throughout China. So any way you look at it, the market, including inflation expectations, is saying, yes, in the short run, we see commodity prices up, but that doesn't necessarily mean that's an inflationary signal. There's nothing more behind it.
Got it. So, the RBA, the Reserve Bank of Australia, also made headlines, sort of buying double the amount of 10-year AGSs. So, I remember in one of your articles on the Alhambra Investments website, you talked about if there's something that the central bank is doing, it's probably tried and failed at the Bank of Japan. So would you say that your rationale for, what's going on with Australian yields as well, just, it's similar, just a similar bout of volatility and just a similar bout of, something that happens every couple of years?
Yeah, and again, it's the overhyping of the volatility in the safe asset markets, and Australia's AGS market is the same thing. I mean, yes, bond yields are up, and they're up more in Australia than in other places around the world. But yet you get out a longer term chart and you think, this is not much of a move at all. If the Australian 10-year is yielding about 2%, it wasn't that all that long ago, it was 4%. And right. So it's one of those things you put in a wider context and you say, okay, what does this really mean? For Australia, the Reserve Bank of Australia, what they're doing is more so trying to preserve the illusion of control, because they implemented yield caps all the way back in March of last year, right, which was intended to be not just, they targeted the 3-year AGS as a specific yield cap, but it was meant to control the entire yield curve. At least that was the theory. And the idea was because they would cap 3-year yields at, I think it was 25 basis points, they wouldn't need to do an extended QE program where they bought bonds week after week, month after month. They'd only need to enter the market in specific places. Instead, what happened is, first of all, yields went lower last September, and now longer run yields are going higher while short-term yields go lower. So it's what part of the curve is the Australian central bank controlling? Right. None of it. Yeah. And so they're doubling up their purchases at the long end in order to try to reimpose some kind of order, or at least to pretend, hey, we control the yield curve, when it's clear they don't control either side of it. And, the rationale for yield caps to begin with is already completely misguided, because what it says is that going back to 2008, whether it's Australia, Japan, anywhere else, the idea that we haven't recovered from that recession, which wasn't a recession in 2008, It must have been for some reason. We keep having these false dawns. We have these reflationary periods that don't go anywhere. And if you're a central banker and you have to come up with a reason for it, you say, well, interest rates rise prematurely, right? We see these long bond sell-offs or these yield curve sell-offs. And maybe that's the reason why they keep short-circuiting the recovery process, because rates get too high prematurely. If you believe in the idea that high rates are constrictive and low rates are stimulus, when historical experience tells you that's exact opposite. What we should want to see is rates rising, because rising interest rates means that investors, especially the financial institution, is selling safe and liquid instruments and taking on risk, which is what a recovery actually is. John Maynard Keynes' animal spirits. So we would want interest rates to rise. But if you're a central banker and you have no idea what's going on, and you think, well, why do we never get a recovery? It always seems to be short circuited. You think, well, maybe it's when rates rise that's the problem, because it's rising rates are supposedly bad for borrowing and lending and credit and things.
Got it. You've pointed out that, March is one of the 2 months. I believe the other one is September, which tend to, usually have some sort of liquidity or some sort of negative market event. So do you think there are signs of a March liquidity event right now?
Not right now. I don't think there's anything that's specific that says, hey, we got a problem just ahead. In fact, it's relatively benign. I think there's a couple of warning signs that say things are still not going the way they should, but that's not the same thing at all. I mean, we see, short-term treasury bills, which is being disrupted by, refunding supply and things like that. You see the dollar has started to rise again. It's the exchange value against especially the Chinese currency has kind of moved a little bit over the last couple, but it's nothing that says, hey, there's something coming up next week that's going to be a big issue. And you're right to point out that there's 2 particular bottlenecks, spring and the end of summer in September, which historically speaking have always given especially the U.S. system trouble. Not just in the last decade or so, but even historically, go back in time, there's a reason why stock market panics usually happen in October. And it really relates to the underlying agricultural aspects of the economy. In the early US economy in particular, there was a rush of money into the interior and outside of New York, and that left New York banks short of funds and short of margin for error. Why that would still continue to be the case into the 21st century, I don't really know. But that, since even, go back to 1998 and LTCM's failure, which was 2 weeks before the quarter end in September of 1998. I mean, there is a seasonality evident in the monetary system that continues on to this day. And the March and September bottlenecks, whatever you want to call them, seasonal quirks, tend to be more of the severe, as they were last year.
Got it. So, one of the things that, I wanted to ask you about was, the fact is that usually inflation and growth is caused, or is, it happens when when commercial banks start to lend. So could you talk about what are the different factors that actually sort of stimulate or that sort of incentivize the commercial banks to lend?
Well, first of it's risk-adjusted returns. It's all about risk-adjusted returns. That's everything.
Do you know what their sort of measure of risk-adjusted returns is? It just
that's where it gets fun and complicated. And what we're really talking about is balance sheet construction, balance sheet factors. What causes a bank, any bank, or the banking system in the aggregate to want to expand or to be able to expand their balance sheet? One of the factors, or one of the things people are talking about right now, is this SLR cliff, which is a regulatory imposition on balance sheet costs. And if we were seeing commercial banks starting to act inflationary, which would be wanting to expand their balance sheet, forward credit and money across the global economy, they wouldn't care one bit about the SLR and what any impact it might be having on their short run costs and balance sheet capital and things like that. They would be rushing all over themselves to say, hey, look, it's going to cost us a little more in the SLR, but who cares? There's opportunity out there. Let's go chase it. And so even in the SLR episode, or this SLR cliff some people are talking about, it's another demonstration for how, however banks put together their balance sheets, and they do it in various ways, they are still not willing to take on heavy risks, not willing to expand themselves in the way we need them to in order to create this inflationary, really actual recovery. The inflation is sort of the byproduct of it. When there's enough money flowing through the economy freely, that's what the inflation is. The inflation tells us that, hey, things are going better than they used to.
Could you explain what SLR is for someone who might
The
not be aware?
supplementary leverage ratio was a belated basal construction that came out of the failure of capital ratios. If you think back to the first financial crisis in 2008, or if you maybe you were not old enough to remember, what you'll see is that banks like Lehman Brothers or AIG, which was an insurance company, but it had financial subsidiaries, Bear Stearns, all the big names you knew, they had more than adequate levels of capital according to the Basel rules. Now, what they had done was they had sort of manipulated their balance sheet numbers, risk-weighted assets and things like that. So that they kind of hid leverage on their balance sheet because they made risky assets seem like they were safe assets. For example, you could buy credit default swap insurance against a particular asset so that you could change its risk weighting, making your capital ratios seem much better. And so there was so much hidden leverage on these bank balance sheets that capital ratios were essentially worthless. And so in the aftermath of the crisis, regulators got together and said, oh boy, the banks really fooled us on this one. So we need to come up with a new number. Rather than thinking about, oh, what are these people actually doing and how does the system work together? They said, no, we'll just create a new number that's actually comprehensive. And so they came up with one, among other things, the supplementary leverage ratio, which says you can't risk weight your assets. We're going to just look at all the assets on your balance sheet and weigh them as they are based on gross notional value. And then we're going to come up with somewhat of a capital ratio based on that. So it's sort of an improved capital ratio. And what it states is that if you're at a certain threshold and you're a designated globally significant investment bank, a GSIB, what that means is that you have to hold a certain amount of your assets in high quality liquid assets. And there's even something called a surcharge. I forget the specific name of it, but it can lead to a surcharge if your assets grow too big. So the SLR basically says, if your balance sheet is this size, you got to hold this much in liquid assets, which is kind of a constraint or impairment or an increased cost of operating your entire balance sheet.
Got it. Do you think like the SLR is a decent measure in your opinion?
No, not at all. It's look, there's lots of problems. I mean, first of all, when you look at it, trying to measure what risks are embedded in a complex money dealing bank's balance sheet is a near impossible task. Start with just a derivative book. How do you include derivatives on any kind of metric like that? And even the SLR proponents will tell you is that we don't really know. We come up with different ways to net. I mean, we allow banks to net out their derivative exposure, which they should. I mean, because gross notional values, it doesn't really tell you much meaningful about how a bank is exposed. And so there's really, not getting too far into the weeds, there's all sorts of weaknesses in the SLR. And at the end of the day, what you're saying is if you have this many assets, we're requiring you to hold this much in high quality liquid assets against it. What are these high quality liquid assets? Well, when you look at them, it's not just US treasuries and government bonds, it's also MBS, including high risk corporates, Euro bonds, all sorts of things that are being called high quality liquid assets that are the same kinds of things that failed back in the first crisis. And then you start to think, well, this SLR business, rather than being a meaningful improvement on bank regulation, maybe it's all just kind of window dressing to get the public, to stop thinking about the banking system and risks and subprime mortgages and things again.
Right.
So it's really kind of more of these, hey, let's create the appearance that we did something more radical and improve regulation, when if anybody goes looking at the nuts and bolts of it, they're like, yeah, this it's the same thing. It's really the same stuff.
Got it. Could you sort of explain the mechanisms behind sort of a Eurodollar loan transaction? So let's say there's a bank in the Cayman Islands that lends money to a bank in, say, Singapore. And could you sort of explain, what would the balance sheet changes be, and what are the mechanisms that are actually involved in that sort of transaction?
It depends on the type of transaction. I don't mean to be, I don't mean to be like that, but it really, I mean, You could do a repo transaction, for example, but the way you book a repo transaction may not be beneficial to your balance sheet constraints. And so instead of a repo transaction, you can kind of recreate repo by doing a currency swap. So now you have a derivative transaction that goes onto your balance sheet only at its market value, but then it's got to be marked to market, which means the value fluctuates. And so that creates sort of problems there too. So maybe instead of that, you want to do a cross-currency basis swap. I mean, essentially, you have all these different ways that go onto your balance sheet and goes onto your counterparty's balance sheet based upon your own balance sheet constraints and what you're thinking about. But the essence of it is this: there are no dollars in it. It's not like the bank in the Cayman Islands is shipping a pallet of cash to Singapore. All they're basically saying is, if you want pallets of cash, I can get it for you. So you're not really borrowing cash from me. You're borrowing a claim I can get cash.
But there's sort of an implicit, expectation that no one will actually ask for the pallet of cash.
Yeah, because nobody wants the pallets of cash. They just want the bank balance sheet IOUs, right? That's all it is. It's basically, cash itself. You go back to the gold standard system. Cash itself was the same kind of derivative. It was a claim on real gold money. And so now we've taken it a step further, where if cash was a claim on gold money, now we have claims on cash, which used to be a claims on gold money. And really, it doesn't really matter. It's basically simply a reserveless tokenized system where the tokens consist of all of the various ways that we can fit these transactions onto a particular balance sheet so that it stays within regulatory boundaries or internal boundaries of risk management and things like that.
Got it. So, when I wanted to take that one step further, I remember I asked this in an email to you, but could you sort of explain, number one, what exactly is a bank reserve? And number two, I wanted to ask you, sir, okay, go ahead. You got excited.
No. This common question, bank reserves. Everybody, what is a bank reserve?
What is it?
Technically, they're nothing more than the byproduct of a Federal Reserve transaction. In other words, I'm the Fed, you're a bank. I want to buy an asset from you, say a US Treasury. I take the asset from you and I credit your account with me at the Fed. That's all it is. It's a deposit account that banks hold at the Federal Reserve.
So what is
up and down based on
deposited with cash?
I'm sorry?
So is it deposited with cash? Or?
There's no cash. It's simply book entry. Now, it gives you the right to convert to cash under certain circumstances, understanding that the early Federal Reserve was created in order to create these, what are really clearinghouse certificates. In other words, they're balances that have a specific interbank use. For example, if you get into the real-time gross payment systems like Fedwire or CHIPS or any of these other things, what you'll see is that, yes, you can use bank reserves to settle any imbalances at the end of the day, but outside of the interbank context, they have no use. It's not like you or I can claim bank reserves and walk into a grocery store and come out with groceries. So in that sense, they are strictly a clearinghouse certificate, which was actually the intent of bank reserves when the Federal Reserve was created in 1913, which was the Aldrich Plan, which was, in other words, to supply currency elasticity through something that isn't really currency. It's a quasi-currency type thing. So bank reserves are nothing more than a deposit balance, a book entry ledger at the Federal Reserve that's created by a transaction between a bank and the Fed.
So if a bank wanted to convert this reserve into cash, but could it sort of be converted into say digital cash? They don't really want the physical cash, but couldn't it just be just a switch on on the balance sheet of the Federal Reserve compared to the balance sheet of the commercial bank? So for example, the commercial bank sees the reserve account go down, and instead they see their cash account go up, and the opposite happens for the Federal Reserve.
No, you can't transfer it outside the system. You could transfer it to other banks in the system. For example, on any given day, using the Fedwire, you have claims coming in against you from other banks. If you end up, say, in a surplus situation where you have more payments coming in than going out, you can transfer these balances at the Federal Reserve, these bank reserves, to another bank who might be deficient. You can lend them out in federal funds, for example. That's the entire point of the federal funds market. Not that there's anybody in there anymore, but that's, theoretically, that's what you did. So they can't leave the interbank ecosphere. And so they have a limited monetary use along the lines of a clearinghouse certificate.
So can they not sell the reserve and get cash? They say to the Federal Reserve, can they not sort of exchange the Federal Reserve, exchange the
Under certain
reserve.
circumstances, they do have the right to convert to cash, which the Federal Reserve has to then ship to them. But see, that's the problem. Just like gold is a problem in terms of how it can be used in certain ways, cash has a problem too, because you can't use physical cash to settle, say, for example, a chips deficiency.
Right.
Physical cash is a hindrance, not a help. So under what circumstances in the modern world would a bank want physical cash? The only reason they would is if they're experiencing a customer deposit or a customer convertibility run, where customers are coming in and saying, going to the ATMs and trying to take cash out, which, I mean, that doesn't happen anymore. Because we're on a digital money system or virtual money system, it really, physical cash is a hindrance.
But say, if JP Morgan wanted to pay, a bunch of employee salaries, they cannot convert those reserves into cash and then pay those employee salaries. Or can
They
do
could,
that?
but it'd be absolutely stupid to. There'd be
Can
no
they not
reason
make
for
the
that to
cash?
happen.
But can they not make the cash like digital instead of actually getting, a physical box of cash?
Well, it already is, but then you have to keep your accounts separate. And that's really what we're talking. When you get into virtual money and this kind of virtual system, it's all about where your numbers go and how they're accounted for. So yeah, I mean, JP Morgan doesn't need to do that because it can just create virtual deposit balances on its own balance sheet anyway. It's a bank.
Right.
So it can create checkable deposits at the stroke of a bookkeeper's pen, to borrow a phrase.
Got it.
So the issue is, and I think going back to, I think the context of the discussion with bank reserves is this money printing, is it inflationary money printing? And the answer is no. And that's been proven conclusively time and time and time again. Whether you go back to I just wrote about the 1930s episode, the level of bank reserves in the 1930s skyrocketed. The Fed, mostly because of gold inflows, but still, the level of bank reserves in the system tripled between 1933 and 1937, making many of the people at the Fed at the time think, oh my God, this is inflationary. Look at all the money that we just printed for the system. Went from about 2.5 billion to 7.5 billion, at a time when $1 billion was a hell of a lot of money.
Right.
And so in 1937, they thought this is going to be inflationary. No, not a chance. Didn't happen. Japan, perfect example. Japan has created more bank reserves than there are numbers, I think. I mean, they're closing in on a quadrillion.
Wow.
That's how much the Bank of Japan is coming. And what's the inflation rate in Japan? Right now, it's negative.
Right.
Not positive.
It's
So
negative. Yeah.
These bank reserves are nothing more than an accounting fiction that is intended to influence people's expectations and behavior. That's all it really is. And it does have a limited use in certain circumstances, as I said before, settling these real-time gross payment system and things like that. But even then, once you get past a certain threshold, you're just adding more useless bank reserves to other useless bank reserves.
Right. And since you brought up the Great Depression, I really wanted to ask your view. Milton Friedman believes that it was in 1929 or 1930. They saw the money supply decline by about 1/3, and back then, you were actually able to define what the money supply is. So, do you agree with that view? Do you think that the Great Depression would have been prevented if the Federal Reserve was not on a gold standard system and all they did was print money, or do you think that's an incorrect view?
No, I think, first of all, I think Milton's view is more nuanced than that. It wasn't the gold standard that created the problem. That's mostly Keynesian economists who believe that. I think what Milton said was that the central bank acted wrongly.
Yeah.
As the monetary problems built up, they misread the situation entirely. If you go look at their statistics, for example, they stopped discounting bills and things like that because they thought, well, demand for discounting is so low, we don't need to add money to the system. Interest rates are falling. Everything must be fine. So they had the wrong view of interest rates. They had the wrong view of the monetary system. I'm talking about the early Fed. And so they stood by and let the monetary system completely collapse.
Mm-hmm.
When what Friedman says, a provision of just 400 million in bank reserves might have forestalled 14 times as much in depository restrictions. That's really the secret to it, was that from World War I until the end of the 1920s, the banking system radically expanded. And the way it radically expanded was in the traditional deposit multiplier. The same amount of vault cash for all of it. Yet I think in 1914, there was about 6 or 7 billion in assets, but by 1929, there was 40. And the same amount of cash. So as soon as 1929, the public got a little bit panicky and started to withdraw cash from the banking system, this massive monetary multiplier had no way to deal with even a small change in convertibility. And so what Friedman was saying is that if the Fed had acted to increase the level of bank reserves, then these clearinghouse certificates might have helped at least aid in the correspondent system with, cushioning the friction of all that withdrawal. And I think that's largely correct. I don't think it would have stopped the depression. I think there would have been a depression in 1930 to begin with. But what made it great was the deflationary aspects of this monetary system that central bankers didn't really understand.
Right. Because I believe Friedman pointed out that the money supply in the U.S. had declined by about 1/3, and he said that the Federal Reserve had acted to, instead of allowing it to decline, at least stay constant or allow it to rise. They could have stopped a lot of the bank runs, and the depression would not have been at least that bad.
Yeah, and that's really the monetary breakdown, similar to what happened in 2007, 2008, was just fragmentation, typical type of, especially interbank breakdowns where dependable sources of liquidity suddenly were not dependable sources anymore. They instead became problems, bottlenecks, and things like that. And the only difference between the Great Depression and 2007, 2008 was that the public was largely outside of it. I mean, there was no convertibility crisis outside of a couple of outliers like Northern Rock or IndyMac. But by and large, this was strictly an interbank breakdown. And in some ways, that's really what happened in the Great Depression too, is that the interbank breakdown became a much larger problem when the public sought to convert deposit balances into physical cash, which banks didn't have. And with the interbank breakdown, they had no way to get it. Right. So if you have tons of customers coming in demanding cash, you only have so much in the vault. Where do you get new supplies of cash? You can't. If you have, usually you get it from the interbank markets, and there's just no way to do it.
Got it. I wanted to ask you, so, I wanted to move to the repo market. Is there any way to sort of measure the velocity of money or the velocity of collateral in the repo market?
If there is, please tell me. No, it's another one of these problems because there's no real-time mechanism. Even when we try to measure collateral velocity and things like that in the repo market, it's only based on published balance sheet statistics or even call reports if you're lucky enough to have those, if you're working at the Fed or one of these other agencies. And that doesn't tell us what's going on a day-to-day real-time basis. That's only when banks happen to report on regular intervals. And banks know enough to cover their butts so that when they report, they're only reporting what they want authorities to know. The old, I don't know if it's an old saying, but some people say that, the published studies from the Federal Reserve and other places say that collateral repledging, rehypothecation takes place between 6 and 8 times. In other words, a single treasury bond that shows up on a dealer's balance sheet has been used 6 or 7 or 8 times. When you talk to people who actually work in the repo market, they laugh and say it's more like 30, or 25 or something like that. So even just that, the disconnect between what we think we know and what probably goes on is, we can't even, how do you even bridge that divide? How do you illuminate this part of the marketplace that nobody even wants to illuminate? And I'm talking not just about the people the Federal Reserve and regulators, the few who know they should be looking at this, and there are very few, but also the banks themselves, because they have special privileges that have been given to them or taken for themselves because of everything. All the stuff takes place in the shadows. They're given money dealers and securities lenders are given a privileged position that they're not going to likely want to surrender.
Got it. So,
we're stuck with these secondary indications. Like right now, for example, you might have heard that especially the 10-year specific 10-year QSIPs have traded very special in repo. In fact, well below the repo fails floor at -4%, which indicates something's going on. There's a shortage of collateral in the system. And normally what happens is people attribute that to, there's lots of shorts right now, which makes sense because with the treasury market crashing and selling off and all these bad things happening, you would expect that there would be a lot of speculative shorts in the market. And that's what's causing the repo specialness. And there's some truth to that, because there are lots of shorts and there's tons of historic level of shorts, but this is nothing we haven't seen before. I just wrote today, going back to 2013, same thing happened. We had a outbreak of specialness in repo that summer as treasury volatility arose and long-term rates sold off. But yet you go back a couple months before all that happened in February and March of 2013, the outbreak of repo specialists took place then, which couldn't have been because of shorts. There was no shorting back. There wasn't a lot of shorting back in early 2013. Instead, it related to the structural collateral shortage we've been faced with since Lehman Brothers and even before Lehman Brothers, on top of the fact that quantitative easing stripped collateral out of the system. So in early 2013, you had all sorts of monetary problems, risks and things like that. At the same time, QE3 and QE4 were ongoing, taking collateral away. And so even before we got to the shorts, repo specials were all over the place in early 2013. So that when the shorting did take place, it just added to an already underlying shortage. So that's kind of sounds familiar to what's going on right now, because what do we have? We've got the treasury market selling off at the long end, which would entice a lot of shorting, but we also got treasury bill yields falling and staying low and a lot of quantitative easing on top of it. So it's a mix of the same 2013 type stuff where you have shorts plus shortage, and it's a repo mess. But the fact that it's, no, that's the point. The fact that it leads to a repo mess indicates there's not a lot that's going right here, right? Because shorting in the treasury market should not create problems. That's a normal function of any market. And any market that's performing smoothly and functioning properly, you wouldn't expect even a heavy amount of shorting to be this disruptive.
Are you seeing sort of like, the treasury market, the 10-year treasury market is sort of not functioning properly? Is that what you're saying?
In the repo side of it, the collateral side of it, yes.
Got it.
What we're saying is that there's such a scramble for particularly 10-year QSIPs that it's causing cash lenders to pay you other counterparties to lend to borrow their money. So if I'm lending money to you, you're giving me a treasury as a collateralized loan, a negative repo rate or a negative special rate is saying, I'm going to pay you to borrow cash from me because I need your security that badly. So that's really, it's an indication that the collateral demand for specific issues or specific maturities and specific securities is so high, I'm willing to pay you 4% annual rate to borrow money from me. That's how, the more absurd it sounds, the more you know that something's not working properly.
And, I wanted to take a jump, to the Chinese repo market, where the PBOC recently made headlines in January, February for withdrawing liquidity from China's repo market, and the narrative was to crush leveraged players. So what is the Jeff Snider take on this China repo rumble?
That's part of it. I don't think that's their particular intent. But remember, the Chinese, or for anybody who doesn't know, the Chinese announced coincident with their 14th five-year plan, they were going to engage what they called a no sharp turns policy, which meant that monetary policy is going to remain neutral. So if they think that things are getting out of control too much speculation, that kind of thing, they're going to adjust monetary policy in order to maintain a neutral stance, which is kind of contrary to perceived view. And I think that's why it made such an impact in the news over here, was because people here, especially in the West, have a mistaken impression of what the Chinese are up to. They think that they're, typical Keynesians, and having run into an enormous amount of economic problems last year, they're going to stimulate the crap out of everything to try to get out of it. When, for several years now, the Chinese have been upfront in saying, no, we're not. We're pursuing quality growth, not quantity growth. And the reason we're pursuing quality growth is because we don't believe there is any growth out there to help us alleviate our financial imbalances and all these other problems that they have. So PBOC 2021, and then of course the GDP target they just released, which is over 6%. When you put all these things together, what the Chinese are saying is, look, we're not expecting much out of the economy this year, and that's going to create problems, but we're not going to change it. We're not going to try to stimulate our way out of this because we don't believe there's any point to it. So what happened in the repo markets earlier this year is consistent with the no sharp turns policy, which says, this is it, man. Whatever we're going to do in these couple of years, this is what it is.
Got it. So, I also wanted to ask you, is there any way to force banks to lend? One of the things that people talk about is that the IOER, the interest on excess reserves, is sort of this, it's sort of like, I guess it's sort of like the opportunity cost of lending those reserves out, or lending against those reserves. So do you think that, eventually, if we reduce the IOER far enough, we will end up seeing these banks being forced to lend. So, they either have to hold reserves, which are at like -1% interest rate, so they're paying to hold it, or they could otherwise just lend out money into the market or lend out money into the economy, and eventually that causes some sort of growth. Is there any way you can put a gun to the head of the bank and say, you better lend?
Well, taking specifically IOER, that's, look, IOER has been down near zero for pretty much the entire time it's been paid out since October of 2008. Outside of the couple year periods in 2017, 2018, and 2019, IOER had been pegged to rated zero anyway. So if there's an opportunity cost to lending that banks didn't seem to care about during that period, why would that change now? I mean, think about it, right? The Fed's saying when IOER was at 25 basis points, as it had been pretty much up until December of 2015, banks were given the choice of holding reserves at 25 basis points or going out into the marketplace and earning much better than 25 basis points. Well, why didn't they? Because 25 basis points is not enough of a return for them to say, we're getting 25 basis points from the Fed, we're happy. No, of course they weren't happy. Again, it's risk-adjusted return. So what the banking system was saying is that even though we're only getting 25 basis points at the Fed and not much in treasuries, those are the assets we want to hold, and we're not going to expand our balance sheets because risk-adjusted returns are not good enough because the risks are too high. That's really the point here. Balance sheets were not expanded because banks still perceived risks being too high. Liquidity risk primary among them, especially when you start getting into these repo issues and collateral problems. You can see why banks might have been somewhat skittish about funding risks and things like that. Better to get nothing or little next to nothing from the Fed on bank reserves you don't need or want than to undertake risks and become the next Bear Stearns. That's sort of an extreme example, but that's really the calculation at work here, is that it's not the level of IOER that's the problem. It's banks who say, I don't want to lend. And so the question becomes, as you asked, what do we do to get banks to lend again? And I think the answer is they have to be presented with a legitimate opportunity to do so. And a legitimate opportunity is not the same system we have that's undependable, run, at least perceived to have been run by central bankers who, are bureaucrats with political considerations. We want a stable, dependable, predictable system where banks can say, I don't have to worry about the repo market and securities lending and collateral shortages because I know it's going to be there if I need it. So we need a dependable, stable monetary system first and foremost, that then convinces banks that it's okay to take on risk, which reduces the risk perception, therefore raises the risk-adjusted return or the perceived risk-adjusted return, because risks in a stable system become much lower.
But isn't that sort of like a self-fulfilling prophecy in a sense? Because,
Of course it is. But, we're talking about money. Money is always about trust. The system is always about implicitly whether or not I trust people on the other side. And what you see throughout history is that there are times when people trust everybody to the point that it's too much. And there are times when people trust nobody to the point that it's too little. And it's, again, getting back to Keynes. Keynes was right. How do we get people into their animal spirits? He more focused on consumers and businesses in the banking system, but liquidity preferences apply to the banking system as much as anybody else. And how do you convert liquidity preferences? And the answer is, it becomes a self-fulfilling prophecy. If you give them a way forward, that's a legitimate way forward, that's what will happen. And that's really what expectations policy at central banks is about. It's about trying to convince banks that, hey, we've got this covered. The problem with that is the banking system knows that central banks don't. So it's not a legitimate way forward, because the more QE they do, the more the banks just shake their heads and say, oh my God, the same stuff over again. I mean, it's not going to work. Right. So it's not a legitimate way forward.
Right. So what do you say? So for example, if I make the argument that, it's sort of lending, that's going to cost growth, which makes it more attractive to lend. So, someone has to sort of kickstart the first round of lending, which causes like the first spurt of growth. So do you think,
that's really what reflation is.
Right.
Reflation is everybody kind of dipping their toes back in the risk pool and saying, okay, things look like they're improving, so let's expand a little bit and see how things go. But what we've seen over the last 13 years is that that goes a little bit and it gets a little bit better and it gets a little bit better. And it starts to get into what looks like the recovery process, the recovery of animal spirits. And then something happens and bam, they all run back for cover again. They pull back the balance sheets. We go back into a global dollar shortage situation, and it all comes crashing back down again. So that's really the problem, is that banks do start to do that kind of behavior, but because none of these structural issues have been fixed, it never gets far enough. It never goes far enough where you can have that self-fulfilling prophecy, which is, the virtuous circle of recovery. And the reason is because we keep running into all these problems that, maybe the public isn't aware of, but certainly the banking system itself can see that, hey, minus 4% on a 10-year special repo, that's a sign of something not being right. And so maybe I start to pull back again. Hey, the Chinese are saying we're going to have 6% growth after a year where it was less than 3%. That's a hell of a hole in the global economy that they don't seem to be in too much of a hurry to fix. That's going to raise the level of risk. So we're going to pull back again. Maybe that's why the dollar's rising here. I mean, so it never can go far enough because we're still stuck in the same situation. And the only solutions that are ever offered are these, smoke and mirror quantitative easing bank reserves type thing.
Would you support sort of, modern monetary theory,
Oh God, no.
But it would cause inflation.
No, I don't think it would.
Why not?
Modern MMT looks like Japan because it actually is Japan. MMT is nothing more than the idea that you pair a central bank with a treasury department and a jobs bank. In other words, the government guarantees a minimum level of employment. If you get thrown out of work at your private job, you go to the government and they give you a job. Doing what? Who the hell knows? Doesn't matter. The MMTers say that we're going to have full employment no matter what, because you're either going to be working in the private sector or you're going to be working at the jobs bank. And we're going to finance that by something called money financed fiscal expansion, which is the central bank buying debt or just monetizing debt.
But wouldn't that be like the real world, like money printer go burr?
No, it's exactly what the Japanese have been doing since 1990.
But it's not quantitative easing, right? They're just actually like
no. The only difference between MMT and what the Japanese have done is that there's no public jobs bank. But the Japanese corporations have done that for the Japanese corporations. Don't lay people off. They already have the jobs bank in place. And so you have money finance fiscal expansion. You have a jobs bank. Is basically all the major components of MMT. And I know MMTers are probably thinking, you got this all wrong. There's much more nuance and all this. No, by and large, MMT looks like Japan.
But isn't MMT like, at least theoretically, isn't it like sort of the government has this credit card that has no credit limit? So they just go about spending as and when they want. And, the central bank just finances all the spending that they do. So wouldn't that finally be sort of, the inflation that everyone's looking for?
No. Again, you look at the Japanese example, look at where Japanese debt is, look at, through some of its more complicated structures like the Trust Fund Bureau, and they have done money finance fiscal expansion to death. They've expanded debt, not just on budget, but off budget. There's all these off budget ways that the Japanese have, quote unquote, injected funds into the real economy for decades. And they have not changed anything one bit. The underlying situation remains where banks in the Japanese system would either rather hold liquid assets that yield negative numbers or slightly positive numbers, or if there is opportunity, they'll swap those yen reserves for dollar reserves and invest overseas, which tells you that none of this stuff is getting into the real economy to the point where the banking system says, hey, something has changed. We're moving into an inflationary period. In fact, quite the opposite. In fact, the more the government does, the more you see the negative results, more you see negative deflationary outcomes because it doesn't fix the situation.
So you're saying that even if we did like full on MMT, if we put, the deficit myth as the way the monetary system worked, we still wouldn't see any inflation.
Well, we kind of went through that this last couple of years here too, right? I mean, the Treasury did all sorts of helicopter drops. We've had 2 of them so far. There's another one coming up. And yet,
But like under the current system, there's like no new money created. Like it's just reserves that are created. But what if we had like new, freshly printed cash that just came off the printing press and, the money could finally be spent by the government? So
you might have a short-term burst of activity. What some people call a sugar high. I don't even think it's
like,
that.
isn't that what like Zimbabwe did, but then like to an extreme?
No,
That's
Zimbabwe is completely different story. Weimar Germany, completely different story. No, the MMT is not hyperinflation. It's not hyper. Again, I argue MMT is super deflationary because it enhances all the worst aspects of the system going wrong. So in other words, you're not allowing bad debts to be cleared. You're not allowing the system to identify new sources of opportunity because you're absorbing labor that might be better redistributed and repurposed to other places. So MMT to me is inherently the same as, again, I hate to say it again, but it's inherently the same things you see in Japan.
So you're basically saying that it's sort of like the public spending is going to crowd out the private sector, and therefore, we won't see any real
among
growth or
other
any
problems.
opportunity.
Yes, absolutely. And not only that, it has the same flaw as what we currently have, not just in Japan, but everywhere. The MMTers think they know what money is. They don't. MMT is nothing more than central bankers trying to do more. When you look at MMT, it's not a strain of monetarism. It's a strain of neo-Keynesianism. It's what MMT is taking the current neo-Keynesian approach and removing all limits from it. Because a neo-Keynesian today would say, yes, you need to boost aggregate demand by fiscal spending, and the central bank needs to be accommodative to do it, but we can only go up to a certain point because otherwise it'll be too much. So the MMT says, well, look at Japan. They've done too much for so many years, so maybe there is no monetary or fiscal constraint, so let's remove it. We're still neo-Keynesians because we believe all the same thing. We believe we understand monetary policy and money, but they do so in the same way that central bankers get it all wrong. So MMT is not really anything other than the same neo-Keynesianism, except with constraints removed, which makes it sound like, oh, that's Weimar Germany. But no, it's not. It's not the same situation at all.
So so sort of the only situation in which we will see hyperinflation is if the U.S. becomes a Weimar Germany.
Yeah.
But do you agree with the idea that
the funny thing is that the Federal Reserve is actually printing a lot more physical currency this year, a lot more. But physical currency is only used in hand-to-hand transactions and primarily outside the United States. So the question is, why are they printing physical currency, and where do they tend it to be going? And it's almost all in $100 bills. And I don't remember the numbers off the top of my head, but it's like a 30% increase in $100 bills being printed, and not because they're retiring old notes that have worn out. If you start following the dots here, what's going on is dollar shortage outside the United States. They're trying to satiate demand for physical hand-to-hand currency because through the bank channel, the Eurodollar channel, it's so dry. There's so little liquidity out there. The Fed is actually trying to meet it with physical currency. So, again, getting back to how do we get out of this, it really is how do we stabilize a global monetary system that the central bank, the Federal Reserve in this case, is in no way equipped to handle.
Got it. So do you even agree with the premise that, fiscal spending leads to some sort of growth? And, what would you say, if a Keynesian came up and told you that, saying what you're saying is like saying that, fiscal spending does not cause anything, saying that it's like, if a person eats food, but then doesn't gain in height, that doesn't mean that the eating food was useless.
Exactly. But we know what the outcome was. In other words, you get into an argument of jobs saved. Oh, well, it would have been worse if we hadn't done this. And the concept of aggregate demand makes a mockery of all economics to begin with, because not all activity is the same. As we've seen time and again across the world, fiscal spending is by and large wasteful. Mm-hmm. And what the Keynesian will tell you is we don't care. John Maynard Keynes said you build pyramids in the desert. It doesn't matter. As long as people are doing something, at least they're doing something. But yet when you accumulate nothing but wasteful spending, what happens? You don't have any underlying wealth. And wealth is not cash. It's not money. Wealth is businesses that are in the black, not zombie companies who are propped up by, fiscal transfers and stipends and things like that. And so that's really the difference. Aggregate demand should come from the private economy building upon wealth. And if you're just doing nothing more than wasting money through fiscal channels, you're not building sustainable wealth. Yes, it can have a short run impact, but outside of that, we shouldn't expect anything more than that. And we should also account for the fact that it's not a neutral proposition, that there are negative impacts to fiscal side anyway. largely because you don't deal with the problems as they actually are. You're just trying to paper over them with a dose of fiscal treasury, whatever.
Got it. So, you talked about the dollar shortage, and, the BIS is the second most useful thing on the Eurodollar system after your writing on the Alhambra Investments blog. So could you talk about, what data does the BIS miss about offshore dollar funding?
Well, I mean, first of all, they miss everything. There's no, in some sense, that's understandable because there's no way to peer inside the system and say, okay, let's start measuring this or that. We don't even know what we need to be measuring. You go back to, 2017 when they wrote about these, what I call footnote dollars, which are derivative transactions that you don't see except on banks' footnote. You go to their annual report and there's 400 pages of footnotes. Well, if you go into certain sections of them, you can kind of get an idea of what these derivatives look like. And what they found was, surprise, surprise, derivative transactions, even if they don't appear anywhere, they function in every bit the same way as debt and money does. So in one sense, it's good that they went and looked at footnotes and said, oh yeah, there's 14 trillion of these things. They function as money, but then what?
Right.
Okay, you made that discovery. Thanks for, stating the obvious, guys. Now what? I mean, what are you doing since then? It's almost like you're damning with faint praise here, because that's okay. You've taken the first step into getting into the hidden shadow system. Why don't you take more concrete steps? Why aren't we looking at the collateral side of things? Which, by the way, the Europeans are actually doing. The ECB in particular has taken a look at what they call securities funding transactions.
Mm-hmm.
But yet it's taken them 7 years to pilot a program. They're not exactly in a rush here. And part of the reason is because they have no idea what they're looking at. And so if you're starting from square one, you can't hop to the end where you're starting to monitor and regulate things because you don't know what it is you need to monitor and regulate. And so that's one of the difficulties when assessing whether it's BIS or anywhere else, is they're still groping around in the dark trying to figure all these things out, which they should have had figured out 50 years ago.
Correct. Yeah. Got it. I've got two more questions for you. So the Markakis Center, which is sort of an economic research center, has sort of, recommended basically two policies. One is nominal GDP targeting, and the other one is inflation targeting, where you sort of have a futures market in for NGDP or for inflation, and as long as the futures market says that inflation is below 2%, the central bank continues to buy bonds. So do you think, number one, this sort of system is any good? Do you think it's going to achieve its objective? Or sort of, since the market is determining what inflation expectations are, or do you think it's also going to go to waste? And
no, it's pointless. I mean, look, we have an inflation target now, and the answer is not, we have to pick a new target. That's not the issue. The issue is, how do you reach your target? Right? The Fed has said we're going to be accommodative in any number of ways until the inflation rate in the United States goes above 2% and stays there for a prolonged period of time. And the reason they've said this average inflation target, is because the inflation rate has been underneath their target for a very prolonged period. In fact, almost a decade. How do you miss your inflation target if you're targeting something? The issue isn't what they're targeting, is how do you actually inject money into the system so that you can reach your target? And that's really where the shortfall lies. Okay, you want to target NGDP? How? How do you get money into the system so that you can legitimately, realistically reach your target? And the Fed has no idea. There's no way to do that. But see, most economists believe that the Fed has this all figured out. The money's an easy thing. They just buy a bunch of bonds, create bank reserves, and therefore that's money printing that leads to all these outcomes. There's very little monetary scholarship in the mainstream, such that they have no idea how the system works. And so it's not a matter of, I'm going to pick a new target. It's, why don't you figure out how to reach the old one?
Target, yeah.
Why don't you figure out why you've been short for over a decade? What is the reason you can't seem to hit a basic target to begin with? And that's really, it doesn't matter what you want to pick as a different target. It still leads you to the same question. How are you going to reach it? And right now, there's no way for the Fed or any central bank, I mean, any of the major central banks that are operating in a wholesale system, to be able to do so. So it's not the issue, it's the target. It's like they have no idea how to do it.
Got it. So, to conclude the podcast, I wanted to ask you, if the U.S. government knocked at your door tomorrow and they said, Jeff, you've got to create a functioning monetary and financial system, given where we're starting right now. So, what would you go about doing?
I'd slam the door shut. No, I mean, look, there's so many things that have to align for something like that to happen. This has to start with the first of all, political will to see it through to the end, right? I mean, you can't start and then stop. If you're going to do it, you got to do it. Mm-hmm. So, I mean, that's to begin with. And before you even get to that point, you have to make people understand what's wrong with the way it is things now, or way things are now, and what needs to be improved upon and why it needs to be improved upon. But assuming you could do all those things, trying to create a stable monetary system, I envision as some sort of digital currency. And I'm not talking about the digital currency that central banks and banks have proposed. I'm talking about a true native digital currency.
Bitcoin.
Not necessarily Bitcoin, because I think Bitcoin is actually disproving itself as we speak, because, a stable monetary system is not one that fluctuates with every little move and everybody thinking, oh, the Fed's printing money and inflation, everybody rushes into Bitcoin, the price goes up into 40, 50,000. That to me is an inherently unstable system. And so, right. Bitcoin to me is kind of proving it's not ready for prime time. But the idea behind Bitcoin, a more mature blockchain technology, that kind of thing, where you write the rules into the actual system that can't be changed, so long as you have, particular rules to do so, which is not an easy task to begin with, but you have a stable monetary system that's predictable, transparent, and reliable. I think that's where you start to see benefits and improvement.
Got it. Any closing thoughts?
Yeah, I don't think, again, going back to our original thought here, what we're seeing in the treasury market is not at all unusual. In fact, this is what happens. And so far, the volatility has been minor compared to other things. And one of the reasons why it's been minor and why treasury yields are much lower than they have been during past reflationary periods is that the risks to the system have not disappeared at all. And despite the fact that everybody's 1,000% convinced that inflation is right around the corner, the market is telling you, no, not really.
That's untrue. Yeah, got it. So thank you so much for being on the podcast, Jeff. Thanks for reassuring all of us that, we're not going to see any growth. That's not a very happy thing to reassure us, but thank you.
Yeah, that's what I do. I bring everybody happiness and cheerfulness.
Thank you.
All right, Sri, take care.